Perfect then. I'm very happy to be sharing this session with two papers that look great. The first one by Bianca Orsi and Sophia Currens on central bank digital currencies and international payment system, the demise of the US dollar. As we will find out soon, with comments by Larissa de Lima. And a second paper by Steffen Murau, Alexandru-Stefan Goghie, and Matteo Giordano, Encumbered security, conceptualizing vertical and horizontal repos in the euro area, with comments by Neilson. So without further ado, Bianca or Sophia, would you like to start?
Yes, so Bianca is going to share the slides and I'm going to...
I'm not sure, can you see the slides now?
Yeah.
Yes, we can see.
Yeah. So Sophia and I have written this paper together with Nina Kautenbrunner. Well, I was really glad that Sophia managed to make it today. So yeah, so we are going to share this presentation. So Sophia is going to start first with the analysis of CBDC, multiple CBDC, retail, wholesale CBDC, and then we are going to move on to the second part where I talk about the role of the dollar in the international monetary system from the light of central bank digital currency. So I'm just going to mute myself, Sophia, if you want to go ahead.
Yeah, thanks. Yeah, so thanks for having us. Can you move to the next slide so we can get it started, Bianca, please? So, yeah, so just real quick is when we started out writing this paper, what we found was that there was limited research or let's say limited accessible papers with regards to CBDCs. There's a lot of policy papers, lengthy policy reports, but we felt that, yeah, the engagement from an academic point of view or kind of more like an accessible kind of CBDC introduction was still missing. So that's part of why we wrote this paper. And the other part, of course, was when we were writing this paper, then we saw that there's a huge interest with regards to international payment systems. So we extended the paper then and you know, gave it our thoughts. So just to start real quick, of course, you know, everyone here knows what money is, but within the theory, a lot of times that is not the case. So money generally needs to perform the functions of money, which is the medium of exchange, unit of account, and store of value. In modern economies, it's an IOU. So whenever you create money, a liability is automatically created. When we then look at the types of money we have, and here specifically with importance to central bank digital currencies, there's two different types of money. It's commercial bank money. It's the IOU of a commercial bank. So every time a commercial bank creates a loan, endogenous money creation, we will have a creation of a liability here, and the liability lies with this commercial bank. All of that money, of course, can also be transferred or converted into central bank money in the form of cash or in form of reserves. But because this is the liability of a commercial bank, we always have the risk of commercial banks going under or going bust, even if there's some insurance here. So that's why I would say this type of money is not risk-free. There's a risk attached to it with settlement and yeah, with regards to losing money. And then we have central bank money. Here, of course, central banks, public institutions that are profit-driven and then more focused on financial stability, monetary stability. Those banks, of course, are the only ones who can create a legal tender. And the types of central bank money we have here is in the form of reserves. So all of the commercial banks have accounts with central banks, and that money that they have in these accounts with the central banks, these reserves, that's digital central bank money. So already some form of digital money, digital central bank money. And then what we also have is cash in the form of banknotes and coins. So, and that type of money is accessible to the public, and the only way the public can access this risk-free money, because when we say the liability here lies with the central banks generally, you know, can't go bankrupt. So that type of money would be risk-free. Settlement is immediate here. So this type of risk-free money in the form of cash, it's the only type of risk-free money yeah, we would have access to, so people, households, companies. Next slide, please. And of course, once we talk about these kind of digital money things, we also have to mention cryptocurrencies. Came about in 2009, the first cryptocurrency, Bitcoin, who laid the foundation for cryptocurrencies. And the argument was made that these type of currencies or these type of assets would actually be some sort of money or could replace fiat currencies. The problem with these currencies is, of course, they're called currencies and not assets. That's the first problem. The second problem is that they don't really hold their value. So with regards to first generation cryptocurrencies, so Bitcoin, Ethereum, all these altcoins, there was never really concern from central banks or regulators in that sense that they could replace the current the current money or threaten the current monetary system. When we then had the establishment of stable coins, that kind of changed, because stable coins, so that will be the second generation of cryptocurrency, and those stable coins can actually, even though we've had like all these issues recently with them, yeah, but they can theoretically act as money, because they do keep the important function with regards to stable value or somewhat stable value, yeah. So that was then perceived to be a threat, specifically when Facebook started to say, hey, we can create our own stable coin, and that can then be used on an international scale within a kind of like a closed network. So that was really perceived to be an issue. And then you could really see an uptick in the research here with regards to CBDCs. Next slide, please. So then, of course, we also need to talk about the future of money. So when we really look at what we've seen with regards to payments, it's really kind of obvious that with the emergence of fintech, but also stable coins, what we've seen is an increasingly digitalization of economies, but also payment landscapes. Yeah. So what we've kind of like gone towards is cashless societies where people use cash less and less. Of course, that then creates issues with regards to, if we don't use cash anymore as the public, eventually we won't have access. If it wasn't for CBDCs, we wouldn't have access to risk-free money. Additionally, there's a possibility that, and we've seen this in lower income economies, that money-like instrument like stable coins could be replaced, specifically when you have these international payments replaced with central bank or commercial bank money, or money that the traditional money that we have. So when we then consider that, it kind of makes sense that central banks, if they want to keep control, if they want to keep ensure that stability is retained, efficiency is retained, and accessibility is retained, then that they would have to develop within these developments as well. So access to risk-free money, financial inclusion, retaining the monopoly of money creation, and most recently, and that's really very recent, the improvements to cross-border payments as of 2020. So these are the motives of a kind of creating these CBDCs. Next slide, please. Thank you. So what is a CBDC? And specifically in the beginning, once you really started to kind of engage with CBDCs, a lot of times it was confused with cryptocurrencies or crypto assets. I think it's just because of the word. But once you really need to, or the difference here really is the liability structure and the risk structure, as well as the overall ecosystem. While you may use the same technology as in blockchain or decentralized ledger technologies, you have a clear liability structure with central bank digital currencies. The liability is with the central bank. For stablecoins or cryptocurrencies, that liability is in some cases not there, or is not very clear where that lies. At the same time, of course, cryptocurrencies, all of them are profit driven versus CBDCs that are not. They're here for stability and not profit motives. So yeah, even though The technology may be the same. They're nothing, so these CBDCs are nothing like what we see with cryptocurrencies. And I'm just seeing here a comment. According to this definition, bank reserves already are a type of CBDCs. Yes, I agree. It's just that we don't have access. Yeah, the only access that we have is in the form of financial institutions. So that type of digital money already exists. The type that we need for the public doesn't. Yeah. So while we have research on CBDCs, the focus, of course, right now is local. So country by country or region by region, but that's, region by region, that's for the EU or EMU. But the focus here really is local, and there's been a lot of research with regards to retail CBDCs and in this local kind of like environment. But what we then have very recently is also focus on international payments, because international payments have, a slow, expensive for specific parts of the world, geopolitical implications. If you want to look at how to diversify away from the dollar, yes, CBDCs could be one way forward. And here in this international sphere, we see both wholesale and retail research, with wholesale really having picked up. Yeah, when we wrote the paper, that wasn't really on the card. There was not so much research in that respect, but very recently a big pickup here. Next slide, please. So wholesale CBDCs, I think, and retail CBDCs. So those are the two possibilities that we have. Retail CBDCs, of course, widely available, probably permissionless. So but with regards to the setup of the system used by the private sector, so households and companies, within economies, but locally, but probably also globally, it will be a new form of money sitting next to reserves, or new form of central bank money sitting next to the reserves that we have within central banks and next to cash. And the reason why, because I just saw a question pop up here, is because we're moving towards cashless societies. Yeah, so that's the reason why we would want, or that's the reason why central banks kind of like go into this retail segment here. Okay, so the retail CBDC, so the way it looks will be something like that. Yeah, central bank issued, it's next to reserves and cash. It's universally accessible, and it's in electronic form. So that's the new thing. Yeah, it will be a direct liability of the central bank, risk-free, not a liability of commercial banks. It's denominated in the national unit of account. So for the UK, it will be a pound. Yeah. Just in digital form. It's kind of like a digital banknote, just in pound. Instantaneous settlement will be possible depending on the underlying technology, but either way, the settlement would be immediate. Yeah, so it's kind of like once you give your pound or cash to someone at the cash register, there's no credit risk involved here. It's different to reserves. It's different to reserves. In that sense, it's different to reserves and cash deposits. Yeah, The big part, that's fine. The big notion here, however, is that the central banks, and they're really pushing for that message to be, received, I guess, is that it's not here to replace money. So as long as there's demand for money in the form of cash, then these digital currencies will not be imposed, let's say, yeah? But there's kind of like, with cashless societies, that's where we're going, yeah? Next slide, please. So when you then look at the international payment system, so the G20, one of the proposals here, like I've said, the international payments, cross-border payments are not fast and not cheap enough. So they must become more transparent, more inclusive, and CBDC is one of the possible solutions that was proposed here. And once you then look at the international dimension, of course, what is needed here is interoperability. So what central banks are asked to do already when they're creating their local currencies, think of the international dimension, because we don't want a further fragmentation of the system. We want kind of like to be interoperable. And that means technological alignments, same frameworks, interfaces, same opening times, but also, that's kind of like the bigger issue, the kind of like same framework with regards to regulation. And that's the bigger issue, but also the one that's probably going to take longer, to be aligned, let's say. There's two possible setups where citizens can hold multiple CBDCs in one wallet. So it's kind of like back in the day when we traveled and got like a different currency and for travel. So a bit like that. And you could then use this to shop internationally, but you don't have to, you can do this from your home. And the other possibility or additional possibility would be multiple CBDC arrangements, MCBDCs, where you have multiple CBDCs aligned in sort of like a framework where you then cross-border payments will be less frictionless. And these MCBDC arrangements, they're the ones that are really being looked at.
Sorry to interrupt. You have 3 more minutes.
Okay, so it looks like that, Bianca, do you want to fast forward and so the most possible, the biggest possibility here, just real quick, is the interlinking systems, So that's kind of looked at. Sorry, Bianca, your turn.
So I'm just going to try really to finish in 3 minutes. I guess, Sophia could spend the 15 minutes discussing the CBC and the possible multiple arrangements. But just to show you here, just a very quick picture of how the current international monetary system looks like. As you can see, across all money functions, you would see the dominance of the US dollar, despite their share of global GDP being diminishing, in the sense that emerging and developing economies have been growing, but not the use of their currency in the international markets. So as you can see here, we have a very uneven, unbalanced system where at the one hand, you have this unipolar international monetary system with the dominance of the US dollar. And here we see the dominance, like I said, across all the types of currency internationalization, where the US dollar stands at the top of what we call the currency hierarchy. And also this comes with a very, very strong political power. So we have to remember that it is also not only a decision from the US, also you can consider the G10 countries. But in 2012, for example, Iran was excluded from the international payment systems in terms of they could no longer transact oil in the international markets. And recently we have seen the same thing with Russia. So on the other hand, we have also been observing a decline in corresponding banking in emerging markets and developing economies. And I think, this is really something really important for us to emphasize, because this shows how, in terms of the structure of the international monetary system, the reliance on not the using the US dollar as the international monetary system. So the question that we are trying to ask here is whether CBDC can be a solution for this imbalances, the fact that the US is at the top of the currency hierarchy in the system, whether we can dethrone the US from the international system. So the argument here is that, okay, multiple CBDC, like Sophia has already explained, would bring some new efficiency to the system, in the sense that it could, first of all, provide financial inclusion, more monetary and fiscal stability. We were talking about this yesterday, how monetary policy in the US affects the global South, and this would not be focused on profit. There will be a reduction in transaction costs, increasing in efficiency, making payments faster, and so on. Another point here is that the MCBDC could potentially bring local currency, especially from emerging and developing economies, to be used in the international context. So this could reduce their dependency on the US dollar, using the US dollar in terms of currency triangulation. And another thing here that could come with the MCBDC is the decentralized power, in the sense that it wouldn't be a decision from the US or the G10 countries to disconnect a country from the payment system like we have seen in the SWIFT, but it would have to be a global decision, essentially a collective decision. So it would be more balanced in that sense. So what our paper is trying to do is essentially to put together two very similar literatures that don't really talk to each other. The first one, the currency paradigm literature, is a literature from economists, mostly from the IMF, like Gita Gopinath and Pierre Gorincha, where they focus mostly on the unit of account, the funding currency, in terms of trade. So they are very much focused on that. So the US dollar has, for example, in terms of commodities, it denominates trades in terms of commodities. So that's a very strong position. The currency hierarchy literature also looks at the unit of account, but instead of in terms of trade, is more in terms of financial relations. And it's precisely because most of liabilities are denominated in US dollars. At the end of the day, you want to avoid a currency mismatch. So you also want your assets to be denominated in US dollars. So it's a very, very strong power for the US dollar here. So when we take these structural factors into consideration, we're talking about here the US funding dollar, the SWIFT, and the power of the G10 countries, and particularly the US in the SWIFT. We see that the US dollar dominance in the international market is not really threatened by MCBDC alone. You need more than this. So as a final remark, Jay, please don't kill me, just one more minute. We see several advantages of CBDC. So first of all, access to risk-free money, and in this increasingly digitalized world, an increasing of efficiency, like I said before, lowering costs of international transactions. But of course, we have to remember that trust, it is essential for CBDC to be internationally used and accepted. We have seen the cases, recent cases of the cent dollar and the e-naira, still very limited. But after the COVID, we have seen now an increase in usage of cash, at least in the UK, which kind of like reverts the pattern a little bit, because during COVID, we've seen the opposite. This may be because of inflation, or, greater perceived uncertainty from domestic and perhaps even international agents. So MCBDC might also help to address these asymmetries in the international market, like we have said before, in terms of reducing the dependency on the US dollar. And perhaps enforce the use of local currencies from developing and emerging countries as well in the payment system and the messaging system. However, this is a bit of an opposing reality, because at the same time that CBDC can be very helpful in huge advantages of using CBDC in that sense, this would only happen in the long term, because it takes a very long time to adjust all of the different regulations and the agreements between these countries. So question here is, what can be done in the short term? So in the short term, we can try to align the legal and regulatory frameworks between these countries. So maybe this is possible, maybe this is feasible. And the US dollar, we have seen the US dollar dominance will not be threatened by the MCBDC alone. So something needs to be done. There needs to be an active policy to implement the use of other currencies in the international system. And just here, a final point of, to provoke the discussion here is perhaps use local retail CBDC in bilateral agreements. So we have seen now over the news on Twitter all over this discussion of President Lula trying to create this perhaps new currency between Argentina and Brazil. This could perhaps be done in the context of CBDC. And my apologies for taking a little bit longer.
Thanks a lot. Super interesting. I'm really looking forward to reading the paper. Larissa, are you there?
Yes. Thank you, Bianca, Sophia, for excellent paper and presentation. I'm going to keep my comments very, very short. So I'll make just two. And I believe that the presentation is already an extension of what I read in the paper, so it may apply a little bit more to the paper. So the first, I liked how you were in the presentation extending and talking a bit more about wholesale CBDCs, especially when we're talking about the multi-CBDC projects. Wholesale CBDC plays a big role, and I think that that's also a natural point to bring back how banks are going to play a role, what new funding models might emerge in the different approaches that these multi-CBDC projects are playing in. Because I think of all the several projects, there's only Project Icebreak that is actually about retail CBDC from a cross-border perspective. So it seems already that you're going in that direction from the presentation. And then the other point, so I think that there's a broader question to be had around the desirability of multiple versus a key currency. I think Perry's presentation yesterday is like a good starting point to be thinking about that. And I'll call out one specific part of his presentation where he's, and there's a phrase in the paper that talks about our current system starting in Bretton Woods. Perry talks about starting it in like the early 1930s with the central banks. And it's interesting to see not just how banks are evolving, but how central banks are evolving and thinking about their role evolving and kind of being specific. So I think a really great complement to your paper is being specific on who is on board, who are the different relationships across central banks that are being formed across these various projects. There's some notable absences, like the US, except more recently in November, when it announced a partnership with Singapore. And Singapore, on the hand, seems to be at the center of all of these other projects. So there's lots of really interesting dynamics that I think would be a great complement. But thank you, and I'll just keep it at that.
Thank you.
Maybe collect a few questions or comments. If you have any, please raise your hand. Matthew. And please keep it short.
What do you think the effect would be of CBDCs on the interest rate, either for, let's say, consumers, their savings accounts at the CBDC, or just yield curves on bonds and things like that? That's all.
Thank you.
I can take that one.
Anyone else? Maybe just the final one, and then you, yeah. Okay. And then you just respond to everything together. Are there any other questions? In that case, please go ahead.
So what the CBDC is doing is the creation really should be representative of cash. So you wouldn't really have any interest rates on the CBDC, and savings accounts, I don't think are envisioned within the CBDC frameworks. What we have seen for already established CBDCs is that we have no interest rate mingling here, because the representation of cash, again, there's no interest rates on cash. What we've seen is there's a limit on how much you can transact or how much you can hold. But what I don't see, or what I don't think CBDCs, that's really just, like they don't want you to save the money in cash. Yeah. So that's, I don't see how it would then have implications for interest rates. Yeah. So the idea that we would have like a disintermediation away from commercial bank savings, that's something that we really don't want from a central bank point of view, or that central banks are aware of, because that would increase instabilities, and that's something that should be avoided, obviously. Did that answer your question?
Yes, it did. Thank you.
Okay, I'm glad.
So I'll hop in with a question. I noticed
I think
sorry.
We're a bit out of time, so perhaps if you want to comment on the comments, so if you want to respond to the comments, let's do that now as well. And maybe Alex, you can post your question in the chat, and they can continue the discussion there, so we have enough time for the second presentation.
Yeah, I'll have a look at the comments there.
Okay, then I see that Steffen is sharing his screen.
Yes, I'm already working on it. So should I just start?
Yeah,
go ahead. With the full screen like this? I'll do it like this. Okay,
yeah,
so great. Well, thank you very much. It's a pleasure, as usual, to be here at the Money View Symposium. I am presenting a paper that is called Encumbered Security, Conceptualizing Vertical and Horizontal Repos in the Euro Area. It's co-authored with Alex and Matteo, who are both on the call. And we are very happy that Dan is going to be our discussant here. It's the first time we're presenting this. And so I'm very curious how it will resonate. So it is a methodological piece. And I want to share a bit the context of this piece. So I myself have been working on like a larger project, which is about conceptualizing the transformation of the Eurozone architecture. And I have previously also presented works from this project here in the Money View Symposium. And so one element of it is a trilogy on the Eurozone architecture, which started off with a piece in 2020, which is sort of the idea, how can we map Eurozone architecture as a web of interlocking balance sheets? And then how can we integrate it into the global system, which is hierarchical. So we've heard a lot about hierarchy already, like today and yesterday. And so the third one, which is still work in progress, is how can we think of transformation? And so on the one hand, how can we describe it as a transformation of balance sheets? But then also how can we theorize it on it from a political economy point of view? And so this third one is like a joint project of Alex, of Matteo and Ludwig. Ludwig can't be here today, sadly. But yeah, we have been spending a lot of energy on it. And so what we got stuck with was really the interlinking of the global financial crisis to the Euro crisis. So there were all sorts of balance sheet contractions of the shadow banking system, of banks in the US. They spilled over to Europe, I mean, complex interlinkages. But then at the end of the day, they also infected European treasuries. So that what became the European sovereign debt crisis. And our hypothesis and our understanding is that the European repo markets really played a key role there. So we need to conceptualize repos in Europe. And we found that is difficult. And we had various balance sheet versions and never really managed to get our heads around it. And yeah, so at the end of the day, we decided we need to write like an interim piece that suggests how to think about repos in Europe. Repos, the Money View literature and critical macrofinance literature writes a lot about repos. So Perry has published a lot, Zoltan. The typical representation refers to, well, US repos in the shadow banking system. So about securities dealers, you've all done the MOOC, so you know that very well. But so when we look at the Eurozone, repos appear in two main contexts. And they're usually depicted as being the same in both contexts, right? So one thing is they are a key monetary policy instrument of the Euro system. So the Euro system is the ECB and all the national central banks. And in the original monetary policy framework, the idea was monetary policy in Europe should be primarily implemented through repos. And then the other way in which it appears when we talk about the Eurozone, it's the secured interbank market. And the secured interbank market was somehow super important for the Euro crisis. So first, when cross-border lending froze, the repo market somehow cushioned it, but then also the repo market stopped doing cross-border transactions. And yeah, this is when really all the treasuries got infected. So when we think about where do repos come from as an instrument, I mean, we can read historical papers. What I found interesting is that it really appeared in the First World War. So it's arguably a bit of a war finance instrument. And what it was used, though, it got popularized when the Fed needed to fund the expansion of US Treasury balance sheets and somehow support these Liberty bond issuances. And the Fed wanted to lend to non-member banks, but it wasn't allowed to. So, I mean, it was just founded a couple of years earlier, but so it wanted to do things that it was not supposed to do. And it used these repos because they have this inherent ambiguity, right? They're called repurchase agreements. So it's the idea it's a sale and repurchase of a security, but at the same time, they are a credit instrument, right? So this mechanism of being credit and non-credit to some extent is really a defining feature and maybe also part of their popularity. And now when we think about how to represent them on balance sheets, we think that this inherent ambiguity always tricks us because there are three things that are part of a repo, namely the creation of a repo IOU, so a debt that is a repo, then maybe or maybe not the creation of traditional money as in reserves or deposits. And then third, something is happening with the security that is used as a collateral, right? So in some respects, it is sold, and in another respect, it is not sold. Also, there are regulatory differences between the EU and the US, and also it changed over time all the time, right? But I want to show three representative examples how it can be put on balance sheets. So there's one way of how Perry did it in New Lombard Street, then there's how Zoltan does it in a Money View piece. And this is Daniela Gabor and Jakob Westergaard, which is the article that gave rise to this critical macrofinance literature. They all worry about repos and they have different strategies to put it on balance sheet. But what we think is this trilogy of show the creation of repo, show money creation, and what happens to the security is never fully there But for our purpose, we really need it because we need to understand what happens with these securities when we want to understand how the global financial crisis turned into the sovereign debt crisis in Europe. And to this end, we came up with an alternative or a new view that we sort of postulate how we can try to put repos on balance sheet. And this is what I'm going to show now. So 3 steps. First step, and that's maybe the first big decision. We think there are actually 2 mechanisms how repos can be created, and we call them vertical and horizontal repos. And we connect this to the monetary hierarchy literature. So very straightforwardly put, vertical repo happens when the institutions are part of different layers of the hierarchy. Horizontal repos is if they're on the same level of the hierarchy. The implication is whether or not traditional money is being created. So a vertical repo, here, for instance, the central bank and a bank, a repo IOU is issued, and at the same time, the central bank creates reserves, which it supplies as a hierarchically higher instrument to the bank, which is hierarchically lower. It could also be a different point in the hierarchy. It could also be a money center bank and a peripheral bank. But so it's across the hierarchy and it involves money creation, which is not the case in horizontal repos, which are for the interbank market, for instance, where we have 2 banks on the same level of the hierarchy. So we also have the issuance of the repo, but no creation of reserves, but it's just lending out of pre-existing money. So in both cases, repos as an instrument are created, but those are 2 different mechanisms. And we think that this is also a distinction how we can disentangle these central bank repos and interbank repos in Europe. But so here, still the security is nowhere to be seen. So what do we do with the security? And there we work with the encumbering asset swap on the repo borrower's balance sheet. And this is where I pass on to Matteo, who's going to continue.
Yes, so what happens with the securities? Crucially, there is a difference in the legal accounting of what happens with a security and the accounting treatment of what happens with the security. Now, as Steffen showed, the accounting treatment isn't very clear, whereas the legal treatment of the securities is dichotomized. In the euro area, securities are outright sold and then repurchased, as it's shown in the first figure. And in the United States, they are not an outright sale. Now, what we argue and what our methodology offers is really a synthesis of the 2 approaches. Okay, we try to bring together both the accounting and the legal treatment of repos and of securities, so that as you can see in the bottom picture, we have the repo liability on the liability side of the bank, of the repo borrower, and then we have the creation of a repo asset on the asset side of the central bank or the repo lender. But the security, okay, the security that is used as a collateral never really leaves the balance sheet of the repo borrower. So what happens to the security is that it is moved essentially from the investment account. It is moved from being held outright to being encumbered, meaning that it is used as a collateral for the repo. So essentially, in terms of the accounting, the security doesn't leave the balance sheet, but then that's what we call repo on the asset side of the central bank, and what we call repo on the liability side of the bank, of the repo borrower, is really this legal claim on the collateral that is underlying, on the security that is being used as a collateral. Now, this allows us then to integrate the collateral frameworks. This is really why we had to develop this paper, and namely, we want collateral frameworks are a crucial part of the eurozone, and I'll show this later. But this accounting methodology of using encumbrance, and especially of not having the securities appearing on the repo lender balance sheet, but having just the legal claims appearing on the repo lender balance sheet, allows us to show the changes in the eligibility of collateral for such repo transactions that you can see here appearing on asset side of both balance sheet. Crucially, on the central bank, you can see that the collateral eligibility, the list of eligible collateral, appears under the repos, meaning that it represents legal claims, whereas on the bank or the repo borrower balance sheet, it appears both as securities held outright and encumbered, but the security that is being used as collateral is shifted from one account to the other. So now we arrived at this approach based on an empirical assessment of what happens, and we took the vertical repos as the example to conceptualize our methodology. And as you can see, vertical repos, meaning repos between national central banks and commercial banks. And if we look at the Eurosystem's disaggregated financial statement, we can see that the programs that are carried out through repos, the open market operations that carry out through repos, do not really show any securities being added to the balance sheet, but they are called as lending to euro area credit institution related to monetary policy operations. And so these are what we conceptualize as our repos. And as you can see, there is no security that appears on the balance sheet, whereas when we have an outright sale and eventually an outright purchase and sale of the security, actually the securities appear on the balance sheet, as is the case with the asset purchase programs. In terms of quantities, these three panels show in the first one the quantity, the millions of euros that have been created through the repo programs since the beginning of the Eurozone. The second panel shows the outright transactions, meaning the essentially asset purchases programs, and on the liability side, we show essentially the creation of this excess liquidity. Now, crucially, both repos and outright purchases create money from new money, and this, as a consequence, this underlines our approach to the methodological theorization of our vertical repos. Now, the most what we consider probably the most important part of our project, namely, how do we integrate collateral frameworks into balance sheet methodology? Because this has not really been done, and it is at the very heart of how we can show these changes in the Eurozone architecture. Now, why does the collateral framework matters? The collateral framework matters for two main reasons. First, it defines the eligibility criteria of banks or commercial banks to access the national central bank balance sheets. Okay, and this is the collateral framework of the ECB of the Eurosystem. And second, collateral frameworks affect the use of central counterparties. Okay, so every different central counterparty will have its own collateral framework, and as a consequence, bilateral repos then can become mediated through central counterparties if the asset that is used as for collateral is eligible for use at that specific central counterparty. This is crucial again because 70% of the secured transactions are mediated through the central counterparties in the Eurozone. Now, as we said, we want to show this changing architecture, and our methodology, our conceptualization of repos allows us to show to do so. For example, here we have a couple of stylized balance sheets. In this case, we have the balance sheet of a random national central bank, and we can see that in 1999, vertical repos could be carried out through the collateral listed under tier 1 securities or tier 2 securities, tier 1 being common and tier 2 being specific to each country. And 20 years later, as of 2023, the collateral that is now eligible has changed quite a bit. Now, as I said, the whole purpose of our notation is precisely to be able to show this expansion or contractions in the eligibility of collateral for repo transaction, both vertical and horizontal, as is showed in the next slide. So, for example, here we took the we look at the Eurex, the CCP, Eurex clearing, and we can see that as of 2005, the collateral eligibility really was relatively simple. We had this general collateral basket in which all euro area sovereign bonds were considered the same and were essentially eligible in the same general collateral basket. And after not the Eurozone crisis really, but after the global financial crisis, what happens is that this general collateral basket is fragmented. And so the eligibility criteria change, the eligibility criteria to access CCP intermediation change. And as a consequence, you can see that now in figure 20, the list of securities eligible is different, and it is segmented depending on the origins of the different collaterals of the different securities. So this in a way what we've done, our new conceptualization of repos allows us to frame the change in collateral frameworks. But then we thought, okay, well, but repos really have a systemic feature in them. So would our notation be able to explain also the reuse of collateral, or for the American audience, the rehypothecation of collateral? Well, yes. In our notation, the reuse of collateral can happen very quite in a very straightforward manner. So, for example, if you take here at time 0, we have, as in the other examples, Bank B borrowing from Bank A through repo, and so this is a horizontal repo, and we show it with the security being encumbered on Bank B balance sheet. And then what we hypothesize is, what if now Bank A wants to borrow from Bank C? Again, with the repo, using the collateral that, not the collateral, but the legal claim on the collateral that they received from the previous repo transaction. Well, our accounting methodology shows that Bank A can do it, and the systemic feature of repos can be still shown in this balance sheet if we show that Bank A uses as a collateral for its own repo not the security, but the legal claim to the security that is still on Bank B. So at the end of the day, we see that Bank B borrowed from Bank A and Bank A borrowed from Bank C, and really the security didn't leave Bank B balance sheet. It moved from being held outright to be an encumbered security, whereas it's this legal claim on the securities that has been used by Bank A to, or that has been reused by Bank A to access Bank C funding.
All right.
We are almost on time. So,
yes,
okay,
I have just 30 seconds to conclude. So just to restate it, so the motivation of this paper is really to provide a repo methodology to put repos on balance sheet in a way that allows us to track through time what happened and what changed in the Eurozone architecture. So we want to show how the repo market spread contagion in the Euro crisis, and then how regulations for collateral eligibility of European CCPs impacted the elasticity space on peripheral treasuries. I think this is really crucial. And then also how changes of collateral eligibility of the Euro system then affected or like backstopped what happened in the Eurozone architecture. We argue that this way of putting it with the encumbered asset swap, we're able to show the creation of repo IOU, the creation of traditional money if it's a vertical repo, and what happens with the security because it's encumbered on the repo borrower's balance sheet. And arguably, we managed to find a way to grasp what is usually said to be the difference between legal and accounting treatment of repos. For the discussion, some points that what we really would like to hear from Dan and from others as well is if you find this distinction between horizontal and vertical repos convincing, And what do you think about this encumbering asset swap? Is this a way to reconcile what happens to the security? We played around a lot with this reuser rehypothecation balance sheet. So we had different versions of it. So this is also basically our best guess for the moment. And in general, what are we doing here? So at the moment, we write in the article that we provide a new notation style, but is that really what we do? Yeah, so any kinds of feedback on these points would much appreciated. And there, stop. Thanks.
Awesome. Thank you. Dan, are you there?
I'm here. And can you see my screen?
Yeah, perfect.
So thank you very much for having me and for inviting me to discuss this paper. I'm very glad to have read it. I should say clearly that I have spent a fair amount of time on the US dollar repo system and much less time on the European repo system, which is your focus here. So I thank you for writing about it, including a lot of details in terms of the history and the institutional structure, which I have not yet had time to extract from your paper. So I'm saying all this as a caveat. However, so my comments will be on repo as repo, informed by the US, but I am trying to reach you where you are. I think, and I'm glad to be able to have some input to this paper before it is done, because I have some suggestions that I do think that you should think hard about before you call it complete. And luckily, we are communicating well, because my points that I want to make respond directly, Steffen, to the questions that you just ended with. So without further ado, maybe the first, in my view, most important contribution of the paper is to propose a way of writing repo on balance sheets. And you do that using the idea of encumbrance. It was your second point, and so I wrote two there, but I'm going to look at it first. This is a restatement in my style of something that was also present in your presentation just now. We have a repo borrower on the right taking out repo as a liability, and that liability is created with a lender on the left. This is what you would call a horizontal repo, where the money side of this transaction is the transfer of an asset, which is the liability of someone of the central bank not involved in the repo transaction in this case. So the thing you add is something like this. Use different words, which I'll come to, but you add a treatment of the flow of securities on the asset side of the borrower's balance sheet. I think that is a good thing to do. The way that I've written it is different in language, but I don't think very different in substance. You talk about encumbrance, and I think the encumbrance, in my language, the encumbrance is the thing that is promised to be removed at the time that the securities are due to be returned. So when I say minus securities, I mean that you give up your free claim on the securities and you take on instead the borrower takes on instead an encumbered claim, which will be in the future removed, that encumbrance, and I record that as an asset. So different words, but I believe saying exactly the same thing as you said. And what I would say needs to be added in your work is a matching balance sheet entry for this, because of this you break quadruple entry consistency when you do this, but I believe that there is another set of entries which matches this very well. If the borrower accepts an encumbrance, you need to think about what is the nature of that encumbrance, and what the only thing that it could possibly be is some kind of gain, a negative encumbrance on the part of the lender. And this must be what it is. The collateral is intended to be security for the loan. So the encumbrance is that if you don't pay back the loan, then you lose the collateral. That must be a gain to the lender. And so you could play with the language and describe it in different ways, but it must be something like this. The lender gains the collateral for the life of the loan, and they promise to give up whatever control they get at the end of the loan. So I strongly suggest, as a recommendation, don't add something to only one balance sheet. You need to think about what it looks like from the other side, because that is what is happening in the repo transaction. If you miss that, then it doesn't make any sense from the lender's point of view. Let me charge ahead here. Here's the same picture. I took out the intermediary, so now we're just looking at the borrower and lender. So now the question of horizontal and vertical, which I think is a very good distinction and an important one. Let's follow that a little bit. So here's horizontal repo, where the money that moves is not the liability of either side of either counterparty. So as you say, we can look at the central bank as a repo lender, put them on the left balance sheet here. And now this is different because the money transaction is the liability of one of the counterparties to the repo transaction. And so this is now vertical repo, as you say, and the difference is in whose liability are we talking about serving as money. That difference matters because what it means is that there's not a constraint, or at least there's not an immediate constraint on the expansion of liabilities through this transaction. The constraint at this point is only in the availability of collateral. The thing that limits the size of this transaction is how much collateral the borrower has, not how much reserves the lender has, which in a vertical repo is unlimited. I should say this, so this is, I got this from your paper and I believe that that's completely correct. But I would go a step further because there are other kinds of vertical repo, right? So what happens if we have the central bank on the other side of the transaction as a repo borrower, or to try to be a little less provocative, an acceptor of repo deposits. So here I have the central bank on the right in the repo transaction, and the movement of money, quote unquote, actually shows up as a destruction of liabilities. Now, I'm not sure that this has mattered too much in the European situation where you are focused, but this is exactly what has happened in the US to the tune of $2 trillion plus rolled over every single day through the overnight repo facility. So if you're going to set up a methodology of repo, I think you should be able to talk about that. And I think you're very close to doing that. It's just looking at vertical repo in the other direction. So far, I haven't said too much about securities. So let me finish up. There's one more case here which you haven't yet considered. I jump over from repo to swaps, and I admit that that's a little outside of your focus. But if you talk to a money markets person, they put repo and swaps together because they're both short-term collateralized loans. So I think as an ambition, it would be nice if your framework could speak to both. And so I wanted to put this in front of you, which is what an FX swap between two central banks looks like. Not just any central banks, but between the Fed and the short list of global central banks, which have dollar swap lines with the Fed. So here is a securitized transaction where both the money side, which is the top line in dollars, and the collateral side, which is the bottom line in euros in this case, are both liabilities of the counterparties. The dollar is the liability of the lender of dollars, and the euro is the liability of the borrower of dollars. We could call them a lender of euros, but this transaction doesn't exist for the Fed to borrow euros. It exists for the Fed to borrow, for the ECB to borrow dollars from the Fed. But it's still structured in the same way. So is this vertical or horizontal is a question I think you should think about. Is this vertical or horizontal? It would be horizontal in the sense that the two parties are treating each other not as equals, but as close as it's going to come, in the sense that there's liabilities of both sides, one on each side of the transaction, but it's not horizontal in the sense that, in quite the sense that you used it before. So I guess I'm asking whether in this situation we need a slightly different language, but I believe it's consistent with the distinction that you are making. It matters because this is the feature of the FX swap lines that allows $400 billion to be created in a matter of days. Nobody has to go looking for collateral because you're using liabilities on both sides. So I say the vertical horizontal distinction does seem useful. I think it could be extended a little bit. Last, I think the collateral framework doesn't go on the balance sheet. I believe that is a mistake because the collateral framework is not an asset. It's much more like a credit line. It's something that could be used, could be tapped, but until it gets tapped, it's not an asset or a liability. It is something else. What is it? I think it's an option. In fact, it's a put option written by the central bank to the credit of the banks who have the ability to unload collateral onto the central bank when they want to. So if you're going to write something on the balance sheet, then you need to establish a valuation of that option, and I believe that is looking in the wrong direction. Collateral frameworks are important, and I think that is a big part of the Euro story that you're talking about, but I don't think that collateral frameworks belong in the balance sheet, and I would urge you to think about it, find a different way to think about that for the next version of the paper. I'll stop there. Thank you.
Great. Thank you so much. We're a bit over time, but Shay told me that we have a couple more minutes. So perhaps let's take 1-2 questions very quickly, and then you have time to reply. So let's start with Alex.
Yeah, so I hear what Dan is saying about, quadruple entry accounting consistency and how this collateral framework violates that. Nevertheless, I think it might be useful to at least, maybe we don't say put it on the balance sheet, but annotate the balance sheet with information about what's going on with collateral, because you have the repo borrower who has, kind of this encumbered collateral that's still kind of on his balance sheet, and then the collateral is kind of split into two places. Like it's an asset that's on two people's balance sheet. It's who it's pledged to and who has kind of the encumbered asset. And I like that. And I like that you started talking about chains of rehypothecation. And I was thinking about, well, how do we annotate balance sheets with that? I guess I'm wondering if it would be more symmetric or straightforward to have, kind of the encumbered collateral on the balance sheet of the repo borrower, and then you can just have encumbered in parentheses like you do, and then on the balance sheet of the repo lender you could put pledged in parentheses or something like that. So it's kind of a dual location asset annotation. It's not on the balance sheet, it's just an annotation. But yeah, I'm thinking about repo dealers who are reversing in collateral and then repoing it back out, and what their balance sheet would look like. And then they would have a collateral or some asset that is annotated as both pledged and encumbered, right? Because they reversed it in and repoed it out. So that's my comment.
Great, thank you. Aske?
Yes, thank you. Just two thoughts to throw in to maybe help or maybe confuse, because I'm not really into this, but what I remember from after the global financial crisis, before or in the running up to the Euro crisis, at least, and it's maybe not a good example, but the Icelandic banks were misusing the line to the ECB. So that would be a case in between of what Dan put up, horizontal and vertical, where it would be banks to central banks in another country. So that's one thread to follow up. And then the other point I would like to point out from, again, also banking, and then it's from the level of the customers of the banks, when they misused the credit lines they would borrow and take that loan and take it to another bank to borrow more and use it as collateral. So when you added the bank C, I think it was only on one slide, it would be interesting to flesh that out with 3 banks on a horizontal level, because it could be rolling over there between banks, even without going between layers. But these are just thoughts of listening to this and looking forward to seeing.
Great, thank you. Barry?
This was really fascinating. I remember trying to learn repo a long time ago, and you pointed to my 2011 treatment where I decided in teaching to follow the money, to put repo on the side of the balance sheet if it's a dollar loan, if it's a money loan, because it is ambiguous, as you say, and that was my judgment. And I like Dan's accounting for central bank swaps as well, because you're taking account of the fact that a liquidity swap is different than a normal FX swap, and because there's the Euro-do aspect of it. I haven't used that, but I'm going to use that in future. So thank you for that. And otherwise, I would align myself with Dan's point on general money view principles, that we're interested in matching the delivery and receipt in time. Okay, and so putting this due thing, says that this is a promise to pay, at a certain point, in time. And so I kind of like that. what I would like to add that Dan doesn't talk about, I think that Steffen, this paper is really interested in the relationship between these two different collateralists. Okay, the one for vertical and the one for horizontal. Okay, and I'm interested in that too. You know, clearly, if you can repo something to the central bank, then you're going to repo it horizontally. Okay, but you are going to repo other things horizontally as well. And here's one way maybe to think about that. When I was really trying to figure this out a long time ago, Dan may remember this. I think he was part of this conversation. We talked to a repo dealer, and he said the following piece of wisdom that I've never forgotten. So I'm passing it on to you. Okay. So this is horizontal repo we're talking about. Okay. He said, it is sometimes good business to accept crap collateral from a good borrower. Okay. It is never good business to accept even the best collateral from a bad borrower. Okay. So this is the point, that the collateral is not just security. There's also the question of whether they're actually going to pay you back. That's actually the question. You don't want to own the collateral. That's the point. You don't want to own the collateral. You want to be repaid. And so that may help in distinguishing these different collateral lists a little bit, okay, and thinking about the relationship between vertical and horizontal. That's it.
Great, thank you. Sorry, Marta, but we have to finish in 2 minutes. So perhaps you can ask your question in the comments. So the authors have 2 minutes to respond.
Okay.
Alex, do you want to respond to something? Because so far only Matteo and I have been talking.
Yeah, first of all, hi all. It's my first time here. Actually, I can't say anything right now. I mean, I can argue against anything that you guys said. I have to be honest. I'm still thinking about that forex swap balance sheet view. I'm still trying to figure it out how we could put it in a balance sheet or what it could mean for our methodology. But yeah, I don't think I have something to comment on.
Okay, so if I may.
Okay,
you
go ahead.
Want to go, Steffen? No.
Okay, then I start. So I have a couple of thoughts. So first of all, this term encumbrance, right? I mean, it really is used a lot. So there were a couple of regulatory decisions. We haven't included them in the presentation, but they are in the paper. So there were regulatory decisions in the EU, but my understanding is also in the US, that really say this is encumbered, right? So this is official terminology. So it's important to, well, appreciate that, to take it seriously. So, and it is possible that also regulations have changed between the global financial crisis and today, but literally, so this is how it works. So we haven't made this term up. We try to make sense of it in a money view logic. So we're also happy to get suggestions to how to improve it. And I will totally think about this view. This may be a way of improving it. We found a paper from the Spanish Central Bank, which was, I think, just published last year or something, which tries to make sense of that. And they have so to make it add up, right? What Dan said, they basically draw an off-balance sheet for the repo lender where the security then appears, right? So then this loan sum encumbrance swap has something that matches it, but it's really, they also say it's not on their balance sheet, right? So it's also not on the ECB balance sheet. That's what Matteo showed, right? So we really we had our balance sheet hypotheses and we tried to match it with the data. And this way, at least it does match with the data, right? And the other point, you said the collateral framework shouldn't be on the balance sheet. I totally understand. We try to write it in a way that it's not actually, so it's not really a, it's not an asset, right? So, but we shifted it in and put it in italics. Well, this is just a way of showing it, but so my point is, it is too important not to be there, because the problems of the Euro crisis were, at the end of the day, all about that, right? So we have to find, as a money view community, a way to reasonably write that. So we're not sure that the way we've done it is necessarily the best one or the only one, but I think it really, really matters to be able to show what was going on. And yeah, so balance sheet methodology should be able to account for that. So not showing it is also not a solution. That's my answer to this. But we'll keep on thinking, and I hope we also keep on discussing.
Great, thank you. I guess it's time now for the break. Shay, would you like to say something?
Yeah, I think we've cut both breaks short. With Dan's permission, we'll start 5 minutes late on his session to give ourselves a quick break now. And at 5 minutes past the hour, we'll get started with the next session.